Hi, this is Erik Epp, and today we're going to discuss stock versus option. This is a part one of two or more in a series. So let's get started. This is a standard risk disclaimer that we are required to post by law very quickly. It says that any investment or trade has a potential risk. You must be aware of the risk and be willing to accept it. Don't trade with money you can't afford to lose. This presentation is not a solicitation or an offer to buy anything. There's no representation being made that any account will make profits or lose money based on this presentation. And the past performance of any trading results or system is not indicative of future results. Let's start with an assumption. Most people believe that options are riskier than stock. Unfortunately, that may not be true. Here's my favorite quote of all times, to be honest. Beware of the man who forms his opinions before he examines the evidence. Was written by Napoleon Hill in the classic book Think and Grow Rich, which took him 20 years to research and complete, and originally was published in the 30s. So let's assume that one normally buys $5,000 worth of shares, but instead decide to buy $5,000 worth of options. So let's use a real example. Dell share is $13.79 per share as of December 23rd, 2010. And therefore, if we take the 5,000 divided by 1379, we can buy 362 shares with the $5,000. But if instead one buys $5,000 worth of Dell, the May 2011, which is basically, I guess, 5 months from now, and at a strike of 13, at a price of $1.58 per share, then 5,000 divided by 1.58 times 100. The reason we multiply by 100 is because there are 100 shares for each option contract. Then we can get 31 option contracts for the $5,000. So if one bought the Dell shares, the stock will have to go all the way down to zero for one to lose all $5,000. However, if one bought the options, then Dell will only have to go down by 5.7% to the strike price of 13 for one to lose all 5,000. Remember, there is 5 months until this option expires. So clearly in this case the options are much riskier because the chances of Dell going to zero in 5 months are very slim. However, for Dells to drop 5.7% in 5 months is quite possible. So clearly in this case the options are riskier. But what if instead we bought only the number of contracts that correspond to the number of shares one can purchase? Since one could purchase 362 shares as per the previous example, then one can buy 3 contracts which correspond to 300 shares, since we cannot have 3.6 contracts, for only $474 in total. That's $1.58 per share for the option price times 300 shares, or you can take $158 per contract, multiply by 3 contracts, you'll get the same answer, $474. So $474 is only 9.5% of the $5,000 that one usually uses for buying shares. The other 90.5% of the $5,000 is still safe in cash and can be invested in other options or other investments for diversification, or it can be earning interest in money market, treasury notes, or CD, or whatever instrument you can get interest on. And this will create a synthetic dividend on stocks that may not even pay dividends. In other words, it pays you something on a stock, almost like a dividend, on a stock that may not even pay you dividends. So the maximum loss potential in this case on the shares purchase is still $5,000. You buy $5,000 worth of shares, they go down to zero, you lose all 5,000. However, the maximum loss potential on the option purchase is only $474, regardless how low the share prices will go. So in this case, which one is riskier? And I think the answer is pretty clear. So thank you for listening to me, and thank you for watching this presentation. Please visit us on the web at kissoptionpigs.com, or you can call us toll free 888-266-4137 for more information. And once again, thanks for watching, and until next time, hasta la vista.